This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the AJ Bell Money Markets podcast. I'm Dan Coatsworth, and this week's episode has some great stories about a mining boss potentially telling porkies about what's in the ground, stocks going bananas in America off the back of a tweet that showed a picture of someone sitting up, and why lab-grown diamonds could scupper one of the biggest potential stock market flotations in a long time. Now, you're probably sounding very confused, but please don't be. Joining me to keep you entertained for the next 40 minutes or so is Danni Hewson.
Hi there, Dan. Hi, everyone. Yes, that all sounds intriguing. What I do know is we're going to talk about FTSE 100 takeovers, potential good news if you're looking to switch energy provider and get a better deal. And with another gloomy update from Burberry, is the British luxury goods maker now the top of the takeover hit list?
And we got some alarming news about under 30s locking themselves into ultra long mortgages, which still might not be paid off by the time they retire.
I'll be talking to the Chief Financial Officer of Shaftesbury Capital about life after the company's merger and dealing with the changing property market in London.
We've also got AJ Bell's Rachel Vahey to explain why some people have to pay emergency tax on an ad hoc lump sum pension withdrawal.
First up, though, let's go over some of the big news on markets since last week's podcast. And Dan, we've got to start with Anglo American.
Yeah, so the FTSE 100 miner, BHP, would love to buy this company. It's made a couple of bids now, both been rejected. So Anglo's come out with its defence saying to shareholders, we see a future in being like a standalone business. We don't need to be taken over. First and foremost, BHP's bid is sort of split into, it's going to pay shares in its own company, but then there'll be a couple of other components of Anglo will be demerged and you'd get shares in those as well. So 3 lots of equity components has definitely not gone down very well with investors. So Anglo sort of made this point and also said, look, we're going to simplify our business. We'll make it even more attractive to you as an investor over the long term. Just going to look at copper, iron ore, and crop nutrients. Of course, that means it's either going to sell or demerge some of the other remaining assets. And that includes a gigantic stake in De Beers, the diamond company. So I think that it's fair to say that De Beers has been a little bit unloved inside Anglo. Diamonds has not been its priority. But this sort of raises a question: who might buy De Beers? I think a luxury goods company might want to have a look. Imagine if you have one of those a company like LVMH and say, like, okay, we can secure big supplies in the future of diamonds, and then we can obviously be completely in control. The Botswana government owns 15% of De Beers. There is some wild speculation it might want to own the whole thing, but I'm not so sure that would happen. Suggestion that there's Chinese companies might want to do it, but also I think we've got a situation here where Anglo's not committing to either doing one or the other. It's basically saying it will sell or demerge. So if it demerges De Beers, this could be a really big float on the stock market. There is some chatter that maybe it would want to choose London because it's already listed there as under Anglo American. But I wonder whether this is going to go ahead. Would that fly? Because one of the key problems we've had in the diamond industry is that while at the moment we've got a downturn in the luxury goods market, but actually for several years, we've seen the rise of the lab-grown diamonds. There was a really fascinating interview on the radio the other day. They were talking about how people who are buying engagement rings, and they were sort of comparing, could you tell the difference between essentially a fake one that's been grown in a lab and a real diamond, and just people couldn't do it. But you could buy essentially a lab-grown diamond for a fraction of the price, and this is sort of basically putting a very big dark cloud over the idea of De Beers, if it was to float on the stock market, would be an easy one to get away. I mean, Danny, I don't know what's your sort of you brushed up on the diamond industry much at all?
Only insofar as my engagement ring. I remember actually we bought that secondhand just because we didn't like a lot of the designs that were around at the time. And because of that, we got a really good quality diamond. And I don't know, for a lot of people, it's the idea of then having something that you can pass on, something it holds its value. So having said that, it sparkles, lab grown diamonds, they still sparkle.
Yeah. So I mean, obviously,
But
so that would, I think investors might take the same view. If lab grown diamonds sort of are no longer sort of seen as a sort of a second class sort of thing here. Lots of people say they look really good, and I think that investors would, if they're potentially thinking, okay, well, I've got this opportunity if De Beers chooses to essentially float, what's the big risk to its earnings? And it's got to be that one. But just quickly, one more thing on Anglo American. Listeners might be familiar with a name called Sirius Minerals. It used to be on the UK stock market, but it was taken over by Anglo American. It's got a project near Whitby up in Yorkshire, and it falls under the crop nutrient sort of pillar in Anglo's new sort of strategy. Loads and loads of retail investors absolutely love this story. The idea that this company could open up this big mining project, restart the UK mining industry on a big scale, thousands of jobs be created. Anglo's come out and said, well, it's still very important to us, but actually we're going to just slow down this development at the moment. So it's like, I think people will just be so frustrated because we've already had endless delays on this one anyway. But am I right in saying, Danny, that you actually went to see Sirius Minerals when it was on the stock market, and you had a good look around this project?
yeah, I spent a lot of time up in Whitby when I was working for the BBC in the north of England, and spoke to a lot of those retail investors that got on board right at the beginning and then had that investment pretty much wiped out when Anglo American rescued the company because it was really struggling back in 2020. It's an incredible site. I mean, it's a beautiful plot of land. But of course, most of this work would take place below ground. And what's absolutely incredible is the idea that they would mine this polyhalite, this fertilizer from Whitby, and then they would create this tunnel. They would dig a 23-mile tunnel. To put that in perspective, that is longer than the Channel Tunnel. And then this material would work its way up the coast to Teesside, and that is how they would then export it out. So, of course, I mean, this is a massive project, a huge amount of cash needed to go into it. And Anglo American had committed $1 billion a year. But as you say, they've now scaled that right back to just 200 million in 2025 and then nothing in 2026. I mean, they're really sort of pausing to try and figure out where best to spend their cash, how best to make sure that their investors, their shareholders are served by their company as they change the way that it's put together, the way it looks. But I think there will be, and I know there is already. I mean, I've heard from a lot of people up in the north of England who are really disappointed. They'd thought that Anglo Americans' commitment would mean that this project was now full steam ahead. And the fact that they've sort of pressed the pause button does raise questions now about its future going forward. And of course, the number of jobs being created. You've got a whole load of colleges up there that are creating courses to make sure that there is the workforce ready to go into this project. So, yeah, there's going to be a huge amount of disappointment, especially because the CEO said only in February that he thought that this mine could be the cornerstone of the entire company. So it feels like he's kind of rolled back there. But, I know that investors had been a bit concerned about the huge amount of cash going into this project and will be quite pleased at this noise that potentially they'll be looking for a partner to take it forward, to share the cost, because the cost is substantial. But I mean, it's an incredible project. And, it'd be interesting to see what happens next, because there's always a lot of question marks about it.
Yeah, so just while we're on the mining theme, there's one little story that caught my eye. Danny, have you seen the film called Gold? Came out in 2016 with Matthew McConaughey. Do you know that one?
No, not missed that one.
It's loosely based on the 1993 Bre-X scandal, which was about with Bre-X, there was a massive gold deposit was supposedly discovered. Essentially, what happened here was everyone got all excited, as you might expect, thinking this is going to be the next great big gold project in the world. Because the share price rallies. What actually happened with Bre-X was it turned out to be one of the biggest stock scandals in Canadian history, and certainly the biggest mining scandal of all time. Basically, one of the people involved in it was kind of fibbing around all the drill samples. So investors were looking at this information and thinking, okay, well, you're telling us that you found all these things because you've been drilling those holes, but the information wasn't correct. And so it sort of kickstarted this complete reform of the mining industry. The big question we've had now is, have we just had a repeat of this situation? There's a company that's listed on the Canadian stock market called Red Pine Exploration. The share price just crashed after the company issued a statement saying, we think the former chief executive tampered with some drill samples, basically saying that the results sent from the lab, and you compare those against the ones that we use in public disclosure to investors, and there's definitely some inconsistencies. Just as we're recording this podcast, the Red Pine was due to give an update. So I'm not sure what actually happened at the moment, but just from that initial sort of allegation, it does look, people right saying this looks almost exactly like the Bre-X thing. And there's obviously some very, very angry investors involved.
No wonder they made a film about Bre-X. I mean, it sounds like a film script, and I haven't seen it, but is it any good? Is it worth watching?
Yeah, it's really good. Definitely worth good. I mean, it's a fascinating insight into obviously the mining sector in a very approachable way. Also, just actually how sort of public markets work as well, because there's quite a big stuff on there about influencing share prices and stuff like that. So yeah, well worth a look.
So we talk about stocks and the economy, and we give film tips as well. There you go.
Yeah.
I'm not so good at fashion tips, but I know certainly a lot of people like that Burberry check. And Burberry, I mean, they've made a lot of money over their standing as this incredible British design giant. I mean, I was looking back, you're talking about the first trench coat was created by Burberry back in 1916. And I think if you see that Burberry check, you know instantly that it is a British company. That fabric just strikes a chord with a lot of people. However, Burberry has been one of the big victims of this cost of living situation, where we've seen particularly luxury goods makers. They initially sort of managed to avoid the fact that people were cutting back, but then those sort of people that have been pushing themselves that little bit further to try and have that little bit of luxury maybe can't afford it anymore. And we also have had, obviously, this huge slowdown of the consumer in Asia. And that has really impacted Burberry. And we had an update today. Its profits have slumped 40%. That is because demand for luxury goods is still challenging. That's what the CEO, Jonathan Ackroyd, said today. Did rule out that they were going to look to close stores, wanted to make operational efficiencies. But no, when you're talking about margins the way that they are, and you're talking about sales not growing, you can understand why this is a business in huge trouble. I mean, we had initially Europe doing quite well early on in the year, but in the last quarter, sales in Europe, the Middle East, and Africa actually fell 3%. Now, the boss was sort of saying, particularly in terms of UK sales, that some of that had to do with the fact that There's been this abolition of VAT-free shopping in the UK, which has meant that a lot of foreign tourists, particularly those that were looking to come on a bit of a shopping spree, were instead choosing places like Paris to go to. But then you would expect that they would spend the money there on Burberry and that it wouldn't impact their profits globally. But this is a business that really has to pull itself up. I mean, its share price has more than halved over the past 12 months. And we were just talking about Anglo American and the fact that it is now very much the subject of this takeover attempt by BHP. And there's been a lot of sort of speculation about whether or not other mining giants or other investors would consider putting in an alternate offer for Anglo American. Well, certainly Burberry now has to be seen as one of the key takeover targets. When you've got a share price like this, it is an absolute classic scenario. And, you know, a lot of British companies at the moment, and I love the phrase that you used earlier, that they were sitting ducks waiting to be picked off by, you know, foreign investors. And we have had, you know, you think about Currys fended off a takeover attempt. You talk about the post office fended off a takeover attempt, Royal Mail, International Delivery Services, and now Anglo American. There are a lot of British companies that look incredibly good value. And of course, a lot of investors look to strike when those companies are at their most vulnerable, because it means that they can pick them off for a song. And I know certainly I've seen a lot of talk today about this potential takeover target, which is now firmly slapped on Burberry, Dan.
Yeah, absolutely. I mean, it's. I think I'm amazed that we haven't actually seen anything in terms of takeover approaches for it, because that share price has been weak for more than a year. Seems to keep going down and down and down. Whether that's just a case of any potential suitors kind of, they can see all the problems on the horizon, particularly with weak Chinese demand, because you can see it in other products as well. Maybe they're thinking actually just play a waiting game, because each day that valuation that we would have to sort of pay to buy Burberry is getting lower and lower. But I guess to come out yet again with another set of results so gloomy like this, you do have to wonder what's being talked about behind the scenes. So there's one other sort of news item I wanted to just flag. It's obviously crosses both personal finance and market territory. So the ban on energy firms offering cheaper deals to new customers could be scrapped from October, because the regulator Ofgem is eager to revive competition between suppliers. So this ban came into place in April 2022 to protect consumers during the energy crisis. It was due to be lifted in March next year. Ofgem says now is the right time to think about removing the ban, because it's saying the energy market is becoming more stable. So obviously, what does this mean? It could mean better price savings, better service standards for consumers, because energy providers, I think they should try and do things, because obviously they're desperate to take market share from rivals, and this is sort of something that they can do. So households haven't been able to shop around for deals on energy for quite a while. So I think removing this ban does open up the market. And effectively, it does incentivize these producers to work harder to offer better deals. So obviously, that's very good for you and I, the consumers. How does that work for investors? Well, when I saw this news, immediately I thought of Money Supermarket, sort of the price comparison website. If you follow Money Supermarket and read what it says in its financial results, it's been doing pretty well, but there's been one area which is like just been static for ages, and that's the energy switching market. And it's been saying that there's no opportunity to grow earnings there at all. So reopening this market effectively gives Money Supermarket a potential earnings catalyst. Now, once you make the join the dots and make that link, you then understand why shares in Money Supermarket nudged higher when Ofgem made that announcement. Particularly if you look at the latest sort of guidance from the company for this current financial year, which was issued last month, it says there's no guidance, no increase in energy switching revenue. So I think investors are now going to sort of be thinking, oh, okay, maybe how long will it take for this sort of market to activate again, and how quickly will people start to sort of shop around for better deals? So yes, it's quite an interesting one to watch.
I would
Now,
imagine people will be shopping around for better deals quite quickly, because we all used to say, didn't we? Every time people were talking about rising gas and electric prices, we all used to say, shop around, switch. That's what you have to do. And we just haven't been able to say that.
Yeah, absolutely. So let's turn our attention to the property sector now. So I think if you visit London for work or pleasure, chances are you'll end up amongst the property portfolio that's owned by Shaftesbury Capital. Now, following what was labelled as a mega merger between Shaftesbury and Capital and Counties last year, the enlarged company's portfolio now covers much of Soho and Covent Garden. Now, we know that property valuations took a hit following COVID lockdown and the change in how we live and work, coupled with the cost of living crisis. Of course, that's continued to cause issues. But the biggest West End landlord had much for investors to like in its first set of results since the merger. And Danny recently caught up with the company's chief financial officer, Situl Jobanputra, to hear about what's going on.
It's been now over a year since Shaftesbury and Capital and Counties merged. The first set of results, saw earnings per share up, an increased dividend. How have you found fitting those two companies together?
Yeah, we've been very encouraged by the early progress on putting Shaftesbury and Capital and Counties together. Very pleased with the first year's results in terms of some of those operational metrics. So you'll have seen that footfall is up. Our tenant sales, and remember that for our shops and restaurants, we collect monthly sales data. So we have pretty good visibility on what's going on a relatively real-time basis. Customer sales were up last year 10% year on year, and we're now above pre-pandemic levels. We've seen significant rental growth, both in terms of market rents and contracted cash rents. We've generated good cost savings, but more importantly, the softer side of things, we're all in one building. We've got a shared and agreed purpose, culture, values. We're starting to see some of those benefits that we knew would be there starting to come through in terms of the numbers. And there are a number of other areas as well. So, for example, recycling of some of the portfolios, buying and selling activity, refinancing activity, all of those things. And as you said, that's translated into good results, good financial results in terms of earnings and dividends. And we think there's plenty more to come.
I want to talk more about that data that you were just talking about, because obviously you've now merged these two portfolios. So are you able to sort of look and think that existing renters in one part of the portfolio might be ripe for expanding, or perhaps a business that is not doing so well might do better elsewhere?
Absolutely, and that's always been a part of our the way we've operated, both both on the Shaftesbury side and on the Capco side. So there are plenty of examples where we can put that data to work and generate interesting insights and ideas from that. So plenty of examples where either a tenant has upsized from a small unit to a large unit, perhaps on the same estate or one of the other estates, or they've built out multiple units, perhaps with a slightly different theme. So, I think that information flow, that data is really important. The way we think about it with our customers, we don't actually like using the word landlord and tenant. We talk about customers. We take a partnership approach. We try to make sure that our interests are aligned, and that increased flow of information, kind of very much promotes that.
Because it's not been the easiest of time for hospitality or retail, even in the capital. Over the last year or so, we've had a cost of living crisis. We've seen wage costs go up. So how do you work with those businesses, with your customers, to make sure that everyone is getting the best out of the estate?
Yeah, I think that the thing for us is making sure that the areas that we manage, and we really focus on 3 large estates: Covent Garden, Carnaby in Soho, and Chinatown. So our job is to make sure that those estates are operating as well as they can. That means creating a fantastic environment for the consumer, for the visitor, creating something which is interesting, different, engaging. And we do that in all sorts of different ways. So that's all about the environment, the public realm, the buildings, pedestrianisation, where we can, and we have that in large parts of our estate. We have outdoor dining. So it's about kind of the physical environment. And then it's about kind of making sure that we have the right lineup of customers, and that the blend and mix of customers is something which is, again, interesting for the consumer. It's going to mean that they want to come back. And then it's about, within the buildings, it's about getting the right use, the right category, and the right brands. And that's not all the same thing. It's something which is different, which you're not going to find in other places, but which all relate to each other and which are relevant to the customer. So I think if we can get those things right, then that means that you can go and have a conversation with an existing customer or a new customer, and you can have a high degree of conviction around what's going to work, where it's going to work, how it's going to work, what you can do to help them. So one of the things we do, for example, is we have quite a lot of land around the building. So, for example, in the Covent Garden Market building in the Piazza, we have a large land holding. We put that to work in terms of marketing events, activations, culture, all of those things. So, all of that really adds to the mix for the customer and the visitor, the consumer and the visitor rather, which means that for our customers, you're giving them the best possible chance of capturing that share of attention, share of spend, and that you're going to get kind of repeat custom. We also have, remember, a good mix of, as well as having a good mix of buildings and a good mix of uses, the customer mix is also quite interesting. So, we estimate it's something like 1/3 Londoners, 1/3 visitors from the UK, and 1/3 international visitors. So that inherently adds a degree of resilience and a good rhythm of customers for all of our restaurant, shops, offices, and residential.
So you have a sort of X factor that a lot of high streets don't have. But one criticism that has been levelled at high streets, and I'm including London in this, has been that in some cases you've seen holes filled by customers, by stores that really are detrimental then to the vibrancy of the high street. I'm thinking about those American sweet shops. I'm thinking about those tourist shops. It must be quite difficult when you are running a business, when you have a vacancy rate now which is slightly higher than pre-merger, not to just stick something in to make money.
Yeah, look, it's always an interesting balance, I think, for property owners in terms of those different demands. For us, vacancy has remained at somewhere between 2.5% and 3.5%. If you look at it on the basis of what's actually available to let, a lot of what we have is under offer, and there are things coming. So we really look at what's available to let, and that tends to hover around 3%, which for a portfolio like this, we think is absolutely normal. And you actually need that level of vacancy to be able to move things around. The way we think about things is that we have something in the order of 600 buildings, something like 2,000 customers. And that means, and remember, that's in relatively aggregated and concentrated ownerships. So we own, kind of streets or clusters within villages, which means that we can take more of a holistic view, and that we can take a longer term view. And what matters for us is how the whole is performing rather than what's happening in one building. Which means that we can take a different view on things. We can try out things in some of the smaller units. We can have brands which are predominantly online, and they have their first physical store. And not all of them will work, but that's the beauty of part of the beauty of what we do, that we can try out things, and that we can very much wait for the right thing in the right unit without worrying about what's happening in one unit out of 2,000. So it's really about getting that mix right, getting the blend right, and making sure that things are complementary, things are coherent for the customer. If you're a customer, if you're a visitor visiting one of these areas, I think you're slightly ambivalent about who owns it. It's about what's there. Is it interesting? Do the things fit together? Is there a good mix of food and beverage alongside the retail? Are there places to stop and pause and rest? Are there interesting things to look at? All of those things matter. Is it within the kind of transport infrastructure which makes it easy for me as a customer to get there? I think all of those things are really important. So I think that scale and that mix kind of really gives us a bit of an advantage in terms of being much more flexible in the way that we can think about individual units. And for us, it's about making sure that all of the the units, the streets, the villages that we have, that we elevate those as much as possible. And elevate, by that I mean quality and choice for the customer, and the type of operators that we have in that.
So your visitors might be ambivalent about who owns the estate, but your investors certainly won't be ambivalent about your need to continue to increase value beyond buying up more companies or more mergers. What is the strategy?
We've got a very clear strategy about what we want to do for the next 3 to 5 years, which we set out recently, and we've got some very clear milestones in terms of what we think we can achieve, and we're very much on track to deliver on those. And that's really around, as I said, we have 600 buildings, 2,000 customers. That gives us a lot of opportunity to improve what we have. So our office is just next to Covent Garden Station. The team are here most days, and the team across the piece will walk the estates pretty much every single day. And when we walk the estates, there are lots of things that we like, and there are lots of things where we see opportunities. I think incrementally, all of those opportunities can make a big difference in terms of the offer for the consumer, what that means for rental income, and ultimately what that means for valuation. The other side of it, so long way of saying there's lots of opportunity in the existing portfolio, and we see a huge pipeline. And remember that we take quite an active approach, so it's not just about kind of letting a unit and then kind of collecting the rent check and forgetting about it for a while. That's the antithesis of what we do. We monitor things very closely. We work with our customers, we regard ourselves as being relatively operational. The other side of it is obviously that we did undertake a merger, which completed a year or so ago. Part of the thesis for the merger was scale. Scale is important because it allows you to do more things. It allows you to be more relevant, both with the customer, with our other stakeholders, and in terms of the capital markets and financing and other things as well. So I think scale is important. And one of the things we do is make sure that we are well equipped in terms of liquidity, so that when opportunities arise, that we are able to act on them. So very recently, we just acquired a building on James Street, which is the main street between Covent Garden Station and the market building in the Piazza, which was a missing piece of our ownership on that street, and that's something that we've been tracking for a long time. We were able to move on that very quickly, both because we understand what's happening in the area, we have a view on the consumer in the area, what the art of the possible is on that street for those units, and we have the financial resources to be able to act on it. So I think selectively we will deploy capital when that makes sense to grow, but we won't grow just for the sake of size. It has to be accretive to what we're doing. And in the meantime, there's plenty to do in the portfolio.
You were saying that your staff are in working pretty much most days, so able to walk around. Obviously, that's not been the case for all London workers. There's been a bit of a hybrid mix. It has impacted valuations. We are in a bit of a flux at the moment in terms of interest rates. They're expected to come down. So how are all of those things together going to affect the valuation of your portfolio?
Yeah, it's interesting what you said about the office market, and I think you're right. I think it's very mixed across different markets and different sub-markets. Even what we found in the West End is it's a very specific market. So, for example, the office product that we've brought to the market, and that tends to be refurbishments, reconfigurations, rather than knock down and rebuild. But where we have brought new product to the market, that has been, there's been very strong demand for that. And that's partly because the office space that we have tends to be relatively small. It tends to be quite boutique. There may be a service provision that goes with it, but the important thing is the amenity around it. So people want to come to work where there are interesting things going around, where you can go shopping or go to the theatre or go to a bar or a restaurant, whatever it is. If all those things are on your doorstep and it's interesting, it's vibrant, it's well connected from a transport perspective, then I think that that type of product, particularly where we have sustainability at the heart of what we're doing, which is incredibly important for us and also our customers, I think that works. So I think we've been very pleased with the progress that we've made on the offices that we have. On valuations more generally and interest rates, you're right. The valuations haven't recovered to where they were pre-pandemic, even though we're seeing sales and operating performance, which is much better. In terms of interest rates, clearly a more accommodating monetary policy should be good for business sentiment. It should be good for consumer sentiment and behaviour, which we think will be supportive of exactly what we're doing. And on a pure valuation basis, lower interest rates tend to be associated with better valuations and lower financing costs. So those factors should bode well for businesses like ours over the coming years.
Certainly, markets seem to be very happy at the moment. We've seen London markets going from strength to strength. In terms of being a place to be listed, a lot of companies have leveled criticism that they're massively undervalued here in London. How does Shaftesbury find it?
Yeah, we tend to focus on things that we can influence and control, which is all of those things that I talked about. It's about rents, creating the best possible operating environment for our customers, making sure that we operate efficiently and have a sensible cost base, that we have a good balance sheet, which gives us a lot of flexibility, that we rotate in and out of assets, that we do the right thing for all of our stakeholders. Those are our priorities. Those are the things that we can influence. We tend not to watch what's going on with our share price 20 times a day, because I think whilst it's sometimes interesting and good sport, I think there's not that much that we can do about it directly beyond actually creating the best business possible and driving performance. One thing I would say on the London market and kind of our investor base, we have a very strong, supportive shareholder base. Is that remember that a lot of our investors, most of our investors, are either based in other parts of the world or can invest, in their mandate allows them to invest in most markets. So a good, just as a good business environment in London is good for what we're doing on the ground. I think a healthy, liquid capital market in London is good for London listed companies. But I think a lot of investors do think about things globally already, and that's certainly the case with our shareholder base.
Situl, thank you so much for your time. Really appreciate it.
Pleasure to speak with you, Danny. Thanks very much.
So play the interview there. So that was Situl Jobanputra, continuing the property theme, should we move on to residential homes and the lengths some under 30s are going to get on that property ladder?
Yeah, this was really interesting. And I had a lot of people asking me about this. And I don't think there's any surprise that when interest rates started to go up, a lot of mortgage holders or first time buyers started to really feel the pressure from those rising interest rates because, of course, it meant higher mortgage costs. And one of the ways that many people looked to bring those costs down was to extend the term of their mortgage. So effectively, they're paying their mortgage off over a longer period of time, which of course means that they'll be paying more interest over the long run, but it means that their monthly mortgage payments will be much smaller. And in some cases, it means that they can keep them at kind of the amount that they had when we had those ultra low interest rates. And Sir Steve Webb, who was the former Liberal Democrat pensions minister, sounded the alarm after he put in a freedom of information request to get some data from the Bank of England. And that showed over 1 million new mortgages have been issued over the past 3 years with an end date beyond the holder's state pension age. I mean, that is a massive amount. So that data showed in the last quarter of 2023, 42% of new mortgages had terms that went beyond the state pension age. It was 38% the year before. And when you are looking at the proportion of customers and the age ranges, you are talking about under 30s, the number of those longer term mortgages have more than doubled over a 2-year period. Now, in some ways, that shouldn't be something to worry about because you look at your mortgage and instead of thinking, right, I've got to pay it off over 25 years, you maybe got to pay it off over 40 years. It's going to cost more, and that is really important. And if you are just making that change as a short-term measure because your mortgage payments have suddenly gone up, cost of living crisis, then it is something that when you start to have a little bit more money in your pocket, maybe when you come to the next point when your fixed rate is up, you can consider changing that term back to maybe 25 years, 20 years, or whatever to reduce the amount you pay in the long run. But whatever you do, what Sir Steve Webb is saying and what a number of other people have been saying, including the Building Societies Association, saying that borrowing into retirement is moving from a niche to a norm. And that raises big questions about whether people realize that the amount that they're saving into their pension, certainly if they're going to rely on their state pension, we hope most people now have a workplace pension or they've got their own private pension, then they need to realize that potentially that amount also has to cover housing costs. I know we get a lot of these sort of these descriptions from various pension associations talking about how much you need to live on to have a certain standard of living. And most of them don't include housing costs. Most assume that you'll be a homeowner and you will have paid off your home and you don't have to factor that in. Now, it is common practice if you are taking a loan out, which will go into retirement, for your lender now to ask for proof of pension because they need to be sure that you can continue to pay that. But it is just something. It's another thing, particularly for those first-time buyers looking to get on the housing ladder now that they really have to think about if they're getting those longer terms. We know people are getting on the housing market much later in life, on average, because they are having to save up huge deposits. But then you factor in that 30, 40-year mortgage, and that is a great big flashing warning sign. I mean, I'm just thinking about my mortgage and I keep looking and I think, right, I've got 12 more years left to pay. That will bring me out at 62. Is that sort of a sum that you're constantly working on? Because I just think about my kids and the potential that they will be in the situation where whatever they think about in terms of their pension, they're going to have to factor in housing costs.
Yeah, definitely. I think it's very much front of mind. I think people getting these long mortgages are just thinking, well, 30 years, well, this is a problem for another day, isn't it? So this is a solution for me to get on the property ladder. If I extend the term of it to as long as possible, that lowers the monthly payments potentially versus if I got a short-term one. And everyone sort of just says, "Oh, we'll deal with it later, or by the time I'll have earned more money and I can pay it off." But I think we have this conversation in 20, 25 years' time. It'd be really interesting to see, who hasn't been able to do that, and they're essentially staring this issue right in front of them. They're coming towards the end of their working life, and they've still got this gigantic potential outflow of money every month. Yeah, so it is a worry, and awareness needs to be raised about the downsides of it, as rather than simply saying it's a solution to get on the ladder. So obviously I know, Danni, you're involved in a second podcast that we do at AJ Bell called Money Matters. I'm right in saying that you've been looking at the broader mortgage market.
Who is the founder of a company called Love Home Swap. So she watched the film The Holiday. We're talking a lot about films in this episode. She watched the film The Holiday and she thought that is a great idea for a business, home swapping. So she created Love Home Swap, then sold it for a huge chunk of money. And now, since then, has been creating other businesses, but also using that money to angel invest, particularly focusing in on female founders. She's also now part of the government's Invest in Women task force. So if you do like listening to a podcast when you're out with your dog, then do take a listen to AJ Bell Money Matters podcast. You can find it wherever you found this one.
Well, it's time for our regular pensions corner. So let's bring on AJ Bell's Rachel Vahey to answer one of the questions in our mailbag. So Rachel, we've got our question from our loyal listeners. It's a very good one. So thank you very much, everyone who does send in these questions. So Anna asks, I've got a SIP I haven't yet touched. I'd like to take money from that pension pot, both the tax-free cash and another lump sum. However, I've been told that if I take this other lump sum, I have to pay emergency tax on this amount. Why is this, and how can I avoid it? Is that an easy one to answer?
Well, it's one we get quite often. It seems to be an area that's of quite a lot of interest to pension savers. So it's definitely worth going through. To start off with, I'm just going to go back a step and just say that pension savers have got a lot of flexibility about how they want to take their money from their pension. And there are two routes that I'm just going to explore. The first one is drawdown. So what you do is you decide how much you want to take out of your pension, and you can take up to 25% of that as a tax-free lump sum. You then move the other 75% over into drawdown. And then you've got flexibility about how much you want to take out of that drawdown amount when you want to take it. So you could take it as a regular amount, or you could just decide just to take a one-off payment out of it. But any of the money that you take out of the drawdown account is going to be taxed as if it was earnings. So that's the first thing to remember. The other common way of getting money out of the pension scheme is to take a ad hoc lump sum. Now, the technical term for this is called an uncrystallised funds pension lump sum, or an UF+, which is why it's much easier to just refer to this as an ad hoc lump sum. But again, it works on exactly the same basis. You take up to 25% of that as tax-free cash, and then the other 75% is taxed as income. Now, the first time you take a taxable lump sum, either from drawdown or from one of these ad hoc lump sums, then pension savers need to watch out, because there could be a potential tax pitfall there. And they could end up with an unexpected tax bill, which could run into thousands of pounds. So they just need to step a little bit with caution here. So this is because if somebody doesn't give their pension provider, or can't give their pension provider, a current year tax code. Now, if the pension provider doesn't get one of those in, then HMRC says to the provider, you just have to tax this whole amount as if it was under emergency tax code or month one basis. Now, what that means is that instead of taking somebody's full allowance, the pension provider has to take 1/12 of that allowance. So if you have a personal allowance, which is 12,570 at the moment, you know that you don't pay any tax on that first 12,570. But when the pension provider is trying to work out the tax due on one of these ad hoc lump sums, then they don't take the full 12,570. They take 1/12 of that, which works out at about £1,050. So already you can see you're going to end up paying a lot more tax that particular way. So for example, if somebody didn't have a current year tax code and they took £50,000 out of their pension pot, 12,500 of that would be tax-free. That would be their lump sum. The other 37,500 would be taxed as income. And under the emergency tax basis, they would be due tax of £15,000, over £15,000, when actually the proper accurate tax position is only £5,000. So you can see it's a lot more money that they're having to pay out. But not all is lost. There is some good news in all of this. What they can do is to reclaim any of this overpaid tax. And they do that by filling in one of 3 different forms. And the form just depends on which form they pick, just depends on whether they are using up the whole of their pension pot or part of their pension pot, or whether they've got other taxable income or not. But if they fill in one of these 3 forms and then send it off to HMRC, they should get their money back.
I mean, so does it take a long time to get that tax back?
No, it wouldn't. If you send your form off to HMRC, they should repay you, in theory, in 30 days' time. So they have a whole cottage industry set up to have a look at these forms coming in and then repay out the money. So you should get back your overpaid tax really quite quickly. But if you're someone like me who just doesn't like filling in forms and never seems to get around to doing it, and you leave it and you don't fill in one of these 3 forms, then you still will get your tax back, but HMRC will just adjust your tax code at the start of the next tax year. So in that situation, it would just take you over a year to get your money back. So it's better really just to fill in one of these forms and send it off to the revenue.
Well, brilliant, Rachel. Thank you ever so much for talking through that. And just a reminder for anyone listening, if you have any pension questions, do drop us a line, podcast@ajbell.co.uk, and we'll see if we can help. But we can't give you individual financial advice, I'm afraid.
Now, Dan, it has been a while since we talked about meme stocks, but they are back with a bang. What's been going on?
Yeah, I mean, God, it feels like it was about 4 years ago, isn't it, that we got COVID hit. Everyone was at home, and then out of the blue we had this great phenomenon where suddenly low quality businesses started to soar on the stock market. Investors were sort of chatting away on the Reddit social media network to talk about them, and we seem to have had another repeat of it this week. If you continuing the film theme, if you've seen the film Dumb Money, which came out fairly recently, that was based on this meme stock phenomena, including the GameStop is seen to be the poster child for meme stock. So this is it's an American chain where you go in and you can get like video games and stuff like that. AMC, which owns Odeon Cinema, that's another one which is doing it. So I guess the question is, why are we talking about it again? Well, last weekend on Twitter, or X as it's now called, we suddenly had the reappearance of the poster called Roaring Kitty. This is Keith Gill. He was credited with helping the struggle, shares in GameStop, which was struggling at the time, exploded in the start of 2021. Now he's not been on sort of posting anything since that meme craze sort of died away. So the fact that he's back on now, and he posted a picture of a drawing, and it had a man leaning forward in a chair as if he was sort of gearing up to do something. Now, that was on Sunday. We're recording this on Wednesday. That tweet has been viewed 26 million times in those few days. And I think what's happened is that the market's going, well, okay, why is he back? What's he sort of suggesting he's going to do? Is he going to orchestrate a new campaign? So we saw GameStop shares jumped more than 70% at the start of the week. We had, like I say, AMC and other those sort of big names like BlackBerry, which were all part of the original meme stock craze. They jumped back, and saw people going here. So it's all the original premise was that investors were looking for beaten up stocks that were heavily shorted, where so big hedge funds were taking a bet that these share prices would fall further. So if everyone clubbed together and started to buy them, it would push the price up and it would force these short sellers to buy more stock to cover their short position. So that was the original premise. And so this is what heavily shorted stocks basically were the target at this time around. And yeah, I mean, it's sort of, the big question is this top of the market stuff? Is it what on earth, triggered this for our kitty man to come back onto Twitter? Yeah.
You've got to hope that he's not got kids and his kids have got hold of his phone and just put out a picture on his X feed, and he's not been using X, so he's not been taking a look. You've got to hope that actually there's more to it, or it's not just a mistake.
Well, there's a load more pictures on there, so if they have got access, they've certainly been playing around with it. So
that is all we have time for this week. Don't miss next week's show, where we'll be joined by AJ Bell Chief Executive Michael Summersgill to get his thoughts on the UK ISA, and we'll also be talking to an expert about opportunities in Europe. Until then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.